Welcome to Tag Economy. Today, we're diving deep into the world of financial markets, exploring how the rich get richer and the rest, well, they just get left behind. In the financial arena, it's a battle between two different schools of thought. You have the efficient markets hypothesis, and then you got behavioral economics. Now, efficient markets hypothesis basically says that markets are like those annoying know-it-alls who always had the right answer. They claim that all relevant information is instantly baked into prices, making markets perfectly rational. Ha! Tell that to the folks who invested in MySpace or Blockbuster. Then on the other side, you have behavioral economics, which are like the younger, cooler kids on the block. Now, this theory is more like, hold up, people are irrational sometimes. And oh boy, do we have evidence of that. Bubbles, crashes, manias, oh boy. But here's the real kicker. Despite all the craziness, they haven't quite managed to overthrow the old guard of efficient markets. It's kind of like watching Biden trying to string together a coherent sentence. Entertaining, but ultimately fruitless.
Well, look.
So, how do we reconcile these two warring factions? Well, enter adaptive market hypothesis. Think of this more as like a Darwinian evolution of finance. Markets and their participants evolve over time, which, means they adapt to their environments just like species of nature. Survival of the richest, baby. So here's how it works, okay? Investors develop heuristics. It's a fancy word for a rule of thumb that helps them navigate the financial landscape. These heuristics evolve through natural selection. If an investor's strategy works, they thrive. If not, they end up like Blockbuster, extinct. Does anyone remember the value investor back from the 90s, Julian Robertson? Well, he got absolutely crushed, particularly in the late 90s. But he would have been a rock star if he'd held on just a bit longer. Behavioral biases are part of this evolutionary process. Some of these biases, like taking bigger risk when you're losing, might have helped our ancestors survive. But in today's market, they're about as useful as a flip phone. The richness of market dynamics comes from the diversity of these heuristics. After the 1929 crash, everyone was scared stiff, avoiding risk like a sketchy taco truck. It's all fun and games until you're sprinting to the bathroom at 3 a.m. But today's investors are bolder, shaped by a period of prosperity. That's why the equity risk premium is lower now. In the adaptive markets jungle, it's not about being rational or irrational. It's about being fit and adaptable. The competition is fierce, and only the wealthiest survive. And let's not forget about the role of precious metals in this game. Gold, the shiny rock that never goes out of style. When markets go haywire, investors flock to gold like it's the last bottle of water in the desert. During economic crises, the price of gold shoots up as people look for a safe haven. It's like that one reliable friend who never lets you down, unlike certain presidents that we know. Precious metals, especially gold, play a crucial role in hedging against market volatility. When the financial seas get rough, gold is the lifeboat that everyone scrambles for. Its value tends to increase as trust in fiat currency decreases, making it a critical part of the survival strategy for the wealthiest investors. Now, let's dive deeper into the world of heuristics. Imagine you're a value investor buying stocks when their market prices are below intrinsic value. This strategy has been successful over time, much like a reliable dog that always fetches the newspaper. However, when the market environment shifts, these trusty heuristics might fail you. During the U.S. stock market boom between 1992 and 2000, value investing took a backseat to growth investing. Investors who stuck to their old heuristics found themselves struggling like a senior trying to operate TikTok. Julian Robertson's losses during this period are a prime example. Had he adapted to the changing environment, he might have reaped enormous rewards. The adaptive markets hypothesis suggests that behavioral biases are essentially outdated heuristics. These biases might have been advantageous in the past, like our ancestors taking bigger risks during a losing streak to secure food. But in modern markets, they can lead to poor financial decisions. Think of the markets as like a rainforest, teeming with diverse species. each with its own adaptive strengths and weaknesses. The richness of market dynamics comes from the interactions of people with different heuristics. This diversity creates a vibrant and ever-changing ecosystem. Just like the Amazon rainforest, the financial market's complexity and resilience comes from its variety. After the Great Depression, U.S. investors became highly risk averse, decreasing the supply of capital to the stock market and raising the equity. Fast forward to today, and we see a new generation of investors, shaped by economic prosperity and more willing to take risks. This shift in behavior is a testament to the adaptive nature of markets. In this dog-eat-dog world of finance, it's not just about being rational or irrational, it's about being adaptable. The most successful investors are those who can evolve with the changing environment. It's survival of the richest, and those who can't adapt are left behind. Now, let's talk more about gold and precious metals. These assets have always been the go-to for investors looking to hedge against uncertainty. When inflation rises or the economy stumbles, gold prices tend to soar. It's like that one family member who always has a backup plan, unlike Biden, who seems to forget the plan entirely. During economic downturns, investors often turn to gold as a safe haven. This was totally evident during the 2008 financial crisis, where gold prices skyrocketed as trust in the financial system plummeted. Similarly, during the COVID-19 pandemic, gold once again proved its worth, showing that some things never go out of style. Precious metals like gold are seen as a store of value, a hedge against inflation, and a safe investment during turbulent times. Their prices are influenced by a variety of factors. This includes global economic conditions, geopolitical tensions, and currency fluctuations, among other things. In the world of adaptive markets, having gold in your portfolio is like having a Swiss Army knife, versatile and reliable. But why gold? It's not just shiny and pretty. Gold has intrinsic properties that make it valuable. It's durable, divisible, and has a long history as a medium of exchange. In times of economic uncertainty, gold's allure shines even brighter, attracting investors like moths to a flame. While gold is the star of the show, other precious metals like silver, platinum, and palladium also play significant roles in the financial ecosystem. Silver, often dubbed as poor man's gold, is not just a safe haven but also an industrial metal. Its price movements can provide insights into both economic stability and industrial demand. Platinum and palladium, used primarily in automotive and industrial applications, offer a unique perspective on economic health and technological advancement. Their prices are influenced by factors such as automotive demand, technological innovations, and even regulatory changes aimed at reducing emissions. In conclusion, the adaptive markets hypothesis gives us a framework to understand the ever-evolving financial landscape. It's a jungle out there, and only the adaptable survive. Whether it's mastering new investment heuristics or stockpiling gold for a rainy day, the key is to stay flexible and be prepared. So, there you have it, folks. The cutthroat world of finance. It's all about adapting to survive. Whether it's mastering new heuristics or stocking up on gold, the game is fierce and only the smartest and richest come out on top. Stay savvy, stay sharp, and remember, it's survival of the richest out there. Don't forget to like, subscribe, comment, and maybe buy some gold, just in case.